So, Stephen, Dalio's talking about the probability of recession.
Right.
How should we be thinking about where we are right now?
Well, look, I think recession probability models are going to look like 40, 50%. They're going to look like a concern. The question is, do we do anything about it? And when you have low inflation, good consumer balance sheets, you obviously are facing this risk of production declines, trade declines, investment declines. But if demand can be cushioned, if it can be protected, I think much like the late 1990s, the 1998 example, you can extend a recovery with Fed easing right now.
Yeah, Brent, are we going to be obsessed with this recession fear story for the weeks that are ahead, or can we get past it by saying that, you know what, the U.S. data has been good?
I think the only way we get past the obsession is if the trade war kind of calms down a bit again. And so that seems to be the back and forth that drives this recession fear. It drives the yield curve. It drives this push to safe assets, which people continue to say is a reflection of a potential recession, which I disagree with a bit. But that's what the big variable is, and that's the only reason that we see to have a recession is that the trade war intensifies so much that it overrides all the other good things, Fed easing, things like that Stephen mentioned out there.
I agree completely, by the way.
And just to that point, Stephen, I mean, we have continue to have a strong consumer here in the U.S. We just got that sentiment number. It was certainly softer than expected. But I wonder, how much weight can we actually put into the modeling for recessions, A, and B, given that fact with all the headlines and all the reporting out there about rising risks of recession, do we run the risk of actually putting ourselves into recession because consumers get scared?
Well, look, I think this is exactly it. The idea that there's a silver bullet, a roadmap that we can all now follow together to know exactly how to time markets and figure out exactly what to do with portfolios, I think that will be a mistake. That recession timing and dealing with this in financial markets is going to be confounding. It won't be as simple as this little trigger. I mean, if the 1 3/4 year yield, was above the 10-year yield last week, then we need to react to that. So I think there's all of those overwrought concerns there, exactly. But I'd just be a little bit careful. When unemployment is at its lowest, that is when you get to the top of the economy. That is when you have recessions. I think that the financial impact of the trade war, again, is marginally driving declines in profits for important cyclical companies. It's what is driving monetary policy. So at the margin, this uncertainty is the most significant risk.
Brent, the list of things that are down year on year, rail car loads, lumber production, coal production, corrugated paper. I mean, does a full trade truce between the U.S. and China get those numbers back in the black?
Yes, because I think it's a bifurcated economy. I mean, the services side has done very well. You mentioned retail sales in the prior segment. The services side still looks good. The side that doesn't is the manufacturing side, and that points the finger squarely at the trade war and the uncertainty that is emanating from it. And so I do think that if you do get a trade war truce, which I think is in the president's best interest, and I think he knows that, and he'll only push as far as he can without tipping the U.S. economy into a recession, if you get that truce, I would expect the economy would re-strengthen. And the one thing I want to note is the only models that point to a recession right now are the ones that are being dictated by the yield curve. That's it. I don't really see any other models that are pointing to a recession risk yet. And the yield curve, to me, has artificial tendencies to it.
Stephen, that is a key point about a bifurcated economy right now.
Right.
And it makes me actually think about 2014, 2015, when you saw the commodity complex collapse,
right.
When you saw what happened with Chinese currency during that time period as well. Does this feel similar to you?
Well, you also saw larger stock market declines.
Yep.
So again, this is a little bit of, what you think about in terms of asset allocation and risk. You're further on in a cycle. But exactly that gap, that the demand side of economies pretty much everywhere are holding in. And if that can be maintained, which takes some effort while you take down cyclical parts of the economy. We've got to remember that there are multipliers here, that if China's economy slows, their suppliers will slow, that there are effects of the two largest economies in the world, and some of these things are in train right now. Whether they worsen or not, again, could change the regime from growth to contraction. I do think that, again, away from just the yield curve, that we have the ability, again, to keep that in an expansion mode.
Yeah, well, that's the job, Brent, of the Fed, and that's going to be the focus next week at Jackson Hole. Is the Fed up to the challenge, so to speak? And are they going to be in a now prolonged rate cut cycle, which is going to be stimulative to the market and the economy?
I do think the Fed's up to the challenge. I mean, they've moved completely from the Fed that you used to know, which was about fighting inflation, to one that is now about enhancing inflation. And so the one thing I hope they do is follow the research that suggests that you go hard and you go fast when times like these occur, because I do believe July was 25 basis points wasted. Now, one could argue that was because the trade war amplified afterwards, but on the day they cut 25 basis points, the yield curve did not re-steepen. I think they need to convince people like me that they are serious about fighting deflation and that they are willing to throw caution into the wind and cut 50 to 75 basis points, even when inflation is not that low and the unemployment rate is not that high.
That's the Tom Lee playbook this morning. Go big or go home. I mean, he wants like a surprise cut, 75 basis points.
Yeah, now it's a little bit harder
September.
to surprise. And, look, I have been more of the view that the Federal Reserve will follow markets. That Powell's guidance at that press conference, which, again, it has nuanced and it would have been a lot simpler to not have a press conference, but was that we do not know what will happen on trade policy. We are not going to preempt and say, well, let's just assume there's a recession. So how would we treat that? And let's hope that there isn't one, right? That's not the Federal Reserve that we have right now. I still think that they can be relatively effective. And again, 9 central banks, aside from the ECB, aside from the Fed. So people are worried about that, but it would be much, much worse if central banks were not reacting to these risks. So if you want to worry about, yields being low, you could worry about them if they were higher.